one of the things that I'm hoping to switch gears to is something a little bit more optimistic, Danny, which is basically, in Australia, we have this problem with home bias, which is we love to invest in ASX shares or ETFs, but even Australian property. But few of us actually want to invest overseas or actually go and do that. We think we want to buy, Nike, Tesla, Apple shares and all that, but we don't actually go and do it. So I guess there's two questions in this. One is like, why should people go and explore these opportunities overseas? And I guess the other one is, can't we just build a portfolio just here on the ASX or here in Australia? Like what's wrong with that kind of idea?
There's nothing wrong, and it's all about risk management at the end of the day. And it also depends on how much money you are actually saving and growing for. But I think the example that I just gave about the property sector in Australia is really important. And I just got some statistics that I thought we could just quickly run through. So in the ASX, and people may or may not know this, if you break down by sectors, financials are 30%. Materials, so the iron ore producers 19, healthcare is 11, and infotech is 4. If we look at the S&P 500, okay, it's complete reverse. You've got infotech at 28% weighting, healthcare 13, similar, financials 11, less than a third or about a third, and materials 2.6 doesn't even count, okay? I'm just going to quickly give you the returns on those markets over the last 10 years, because again, I'm trying to frame a picture for your listeners. So on the ASX 200, everybody knows that dividend payments are really important. They're almost half of the return of your Australian share portfolio. For the typical investors that have made the most out of the high yielding banks, material sector recently, also Telstra. So the total return out of the ASX 200 over 10 years has been 10.9%, whereas the price return is 6.4%. So that shows you how important the dividends and the franking has been. When we look at the US, really interesting. So complete reverse, because obviously the big FANG stocks have been the major performance. But if you look at the price return over 10 years, more than double, 14.2% from the S&P 500, and the total return 16.6%. So you do get dividend income even out of technology shares and the S&P. So why I think it's important for investors to consider when they are investing. And you don't necessarily have to go overseas to get that exposure, because ETF products now in Australia are providing much better diversification to global stocks or to the US market and to themes. But the point is that when experts manage their portfolios, they don't basically have too much exposure to one sector or to one country. So your super funds would be investing across a spectrum of assets. So they would not only hold Australian shares, they would hold infrastructure assets. And you've seen so many examples of how much demand there is for Australian infrastructure assets. So unfortunately, every time a super fund or a private equity fund goes and buys them, the retail investor like you and I are actually now not able to buy that asset. But they also invest overseas. And I think the point is, it's not like you have to, but why wouldn't you want to be part of some of the biggest, most amazing, best companies in the world that are going to be able to grow outside of the natural business cycles? And that's the bottom line. It's about diversifying your exposure to those companies that you know, that you use. And people say to me, but isn't the US really risky? And you go, well, I don't know. If you can buy cryptocurrencies, which are unregulated, have no transparency, have potential for high levels of regulation, yet you say you can't buy something like an Apple, which has a market cap that is greater than many countries' GDP and more cash than you can poke a stick at, and is going to continue to grow and will not go under. And if the US is in problem, then the whole world is in problems. I think the problem is many people in their own countries get natural bias. And I guess I just wanted to open people up to how wonderful the investing opportunities are, particularly into the US. I'm not so bullish about other countries around the world, but we'll get to that. But it just, to me, it's like, if you're young and you have the opportunity, why wouldn't you put some money there?
Yeah, it's amazing when you start to look beyond our borders, and Australia is such a small part of the overall financial market. But yeah, as you said, we sometimes get a bit scared about leaving our country, and we think that other countries are inherently riskier when it's almost a risk not to invest in a broader array of companies, and because we get really focused on our large dividend paying companies in Australia.
Yeah, and there is a risk with that because they've underinvested over the years, and you're seeing that the banks are being fundamentally challenged by fintechs. And I think you can continue to assume that that is going to happen. Our banks are very exposed to property, and that's a phenomenon that's across the world. It's not peculiar to Australia. But I guess it's a thing, like you can go and buy smaller cap stocks in Australia that might give you some exposure to some of these secular themes. But by definition, because they're smaller, newer, they're typically higher risk. And that's the thing. If you can buy a great company that gives you exposure to the cloud or to cybersecurity, but it's been around a lot longer and it's got a proven track record, to me, that is a better risk-adjusted assessment than buying a small cap that might do well for a couple of years, but then might have lots of problems.